How I built a $100,000 strategy that completely transformed my trading. 6 years ago, I was obsessed with finding the perfect trading indicator. I thought somewhere out there was a magical combination of settings that would finally make trading click for me. But somewhere along the way, I started asking the question, what if the perfect indicator doesn't exist? And what if there's actually a completely different approach that works a lot better? So I went searching. And since then, I've generated over $100,000 using a momentum strategy. Now, this isn't my whole portfolio of automated strategies, but in this video, I wanted to specifically talk about a momentum strategy I'm running in crypto. And this isn't just theory or backtest results. This is coming from live positions with real capital at risk. And here are just some of my current trades on Hyperliquid. Hyperliquid is a decentralized exchange where you can easily kind of submit orders on multiple different tokens and use a bit of leverage as well. As you can see, some is being used here when you diversify your portfolio across many momentum signals. It's also how I caught this trade on Pump. Since then, I think we closed this trade at about like $50,000 profit, give or take. And this was a very good momentum kind of long. So in this video, I want to go over the principles that build profitable momentum trading strategies, why simple beats complex pretty much every time, and how I avoided curve fitting traps that keep most traders stuck in the indicator hunting cycle forever, like I almost did. Now, if you're wondering what curve fitting means, don't worry, I'll explain it later in this video. Now, the first principle, as I've already kind of alluded to, is start simple, stay simple. The best momentum signals I've used are embarrassingly basic, such as distance from a moving average, rate of change over multiple timeframes, or even just breakouts, breakout of all-time highs, 30-day highs, etc. Now, if you do want to get a bit fancy, you can make your signals continuous and not binary. What this primarily means in practice is instead of if price is above 100 EMA, go long, which would be a binary signal, you would measure the distance to the SMA, and this gives you signal strength by how far it is from that SMA, for example. This allows you to have a continuous signal, which can adjust position exposure, you guessed it, continuously. But doesn't this break the idea of being simple? Well, simple in trading, at least from my experience over the past 6 years, is the 80-20 rule of trading. 80% of actual returns will come from the main 20% of simple rules and principles. But that doesn't mean you can't add to it. But most importantly, it's when it makes the trade-off worth it. Now, that trade-off, what I'm talking about here is if adding a bit of complexity significantly improves either returns, risk-adjusted returns, your drawdown, for example, stuff like that, then it can make sense to maybe add a bit of that complexity. But you have to understand that every bit of complexity you're adding, you're increasing the chances of you overfitting historically and just creating a strategy that overall isn't going to work onto generally applied markets. Now, I know some of you may be more curious about this continuous and binary signals. I have gone over, I think, in previous videos, but to give you a bit of a visual for it, normally this is kind of called analog and digital. So digital is where you're going from, think of like a switch, for example. So it's either 1 or 0, so binary basically. And in traditional trading signals, like I was kind of mentioning with that EMA one, if this condition is true, you're going long. If it is not true, then you're exiting that position. So it's a very binary way of looking at it. An analog or continuous way of looking at it is that you're on a spectrum, basically. So think of -1 to 1 or 0 to 1. And from that spectrum, you're adjusting your exposure continuously, which means you are going to have higher turnover. And turnover basically just means you're entering and exiting out of trades more, you're going to be accumulating more commissions, but you have the advantage of that you're continuously adjusting that exposure. So you're always more well positioned than a digital or binary signal. Now, why I said, if you want to get fancy is because obviously this adds complexity. It adds complexity in automation. You primarily couldn't really do that in a manual way, so just manually constantly changing it. Maybe you could if you sat at your computer all day, but for the most part, you'd probably want to automate that using some code. Whereas a binary signal, you can actually manually execute that completely no issues. But as we were kind of saying, the digital version, while it still works, it's the 80-20, you can improve upon it and make it less inefficient, let's say, and you can do continuous, which is a more efficient and better version of that model. Now, number 2 is avoiding the 3 types of overfitting. Now, overfitting, simply put, is when you're doing a backtest and you're heavily optimizing a particular strategy, for example, and it's fitted to historical noise rather than being generally applicable to new live data or out of sample data. So out of sample data is data you haven't trained it on or you haven't exposed it to historically. So traditionally that would be either out of sample testing or it would just be new live market data that's coming into the system. And the 3 main types of overfitting, now I will say I've robbed these from Robert Carver. Some of my previous videos about books, he's the author of them. He does some great books on these sort of topics. And he kind of breaks it down into 3 different overfitting types. You've got explicit, which is running 50 backtests and picking the best one, for example. This is a very classic and easy mistake, but if you're training over the same data constantly and then you're just picking the best one, that's explicit fitting. Then you have implicit fitting, which is testing an idea and seeing if it doesn't work and then modifying it until it does. Each tweak uses future knowledge you wouldn't have had in real time at that point of time of testing that strategy. So think about running a backtest for the 29 EMA and it completely not working, and then you try the 29.5, then you try the 30, then you try the 31.5, like that is slowly getting more to implicit fitting. Now, this is all, I would say, sort of on a spectrum. There is like not that bad where you have to do a bit of optimization to improve strategies, but the more and more you do, the worse you're getting to overfitting. And then 3 is tacit overfitting. So this is things that you inherently know, for example. So I know momentum works. So you keep tweaking until it looks perfectly historically. And then that can lead to tacit overfitting. The reality is you can't polish a turd. You can put a bit of glitter on it, but if the core logic isn't sound, optimization isn't going to save you. It's just going to look better historically, give you false confidence. And then when you actually take it live, it most likely won't work over a long enough period of time. Now, that's why I actually focused on momentum, especially when I got into crypto, as it's consistently been present in different markets for decades. I do similar momentum strategies in my futures automation strategies as I now do in crypto. Put simply, momentum is the idea that assets that went up will continue to go up, and anything that went down will continue to go down. In principle, it's very similar to Newton's law of motion, where you can kind of see some acceleration and deceleration trends, but primarily if that's something set into motion, it will continue kind of rolling into that motion. We're going to get onto another very important point later in this video around this topic, so make sure to stay for that. But the next topic is position sizing is everything. Here's how I think about momentum positions. 1, you put trades on when you have an edge in proportion to that edge. So what we were kind of talking about earlier with continuous, for example. 2, take them off when the edge disappears, so when there's no longer momentum present. And then 3, sizing accordingly to signal strength and not arbitrary percentages. Most traders use fixed position sizes or arbitrary stop losses. Now, at the beginning, there's nothing wrong with that, but you do quickly learn that those are quite inefficient for actually returns. And both of these approaches are going to leave money on the table. But they do also require you to be a bit more fancy, let's say. So there's nothing wrong starting with those basic ideas and then improving upon it as time goes on. Now, number 4 is the markets matter most. Here's the truth. You can have the best momentum system in the world, but if you're trading sideways markets, you'll struggle. For example, like some of my momentum strategies I have in futures, normally they work best on indexes or gold because gold is amazing for the most part of trending. But if I put it on YM, performance was normally going to drop or not actually even be profitable sometimes. That's not necessarily saying that that momentum strategy is bad. It's just, it wouldn't be applicable to that particular market. And right now, crypto probably offers the best momentum environment I've ever seen. And that's why I've been kind of pushing heavy on it, because I have my futures portfolio, which is around 10 automated strategies. But now I'm adding those extra strategies into crypto as well to get exposure to those extra returns. And the reason is the trends are stronger in crypto. They normally last longer and they offer a bit better risk-adjusted returns than most traditional markets from what I've seen. But don't get me wrong, crypto has higher variance, meaning you're going to have higher volatility. But I'm happy to accept that higher volatility and variance because it leads me to outperform a lot of other traditional markets. Plus, when I have it with my foundation of, futures automation strategies, it's a great adder on top. But the point of this is it's not just about the strategy. It's about deploying that strategy in the right market or in as many markets as possible. Technically, the ultimate way to do momentum or trend following is to be exposed to pretty much every market across the board. And then you can capture where trends are existing today. But at least right now, it seems like a lot of those are in crypto. But you can find amazing trends, for example, in commodities, but they're just a lot more rare. Now, number 5 is the real edge. Building a profitable momentum strategy isn't about finding the perfect indicator or optimal parameters. It's about adding simple, logical signals consistently, avoiding overfitting traps, trading the right markets with it, or as many, depending on your infrastructure, proper position sizing and risk management, and maintaining conviction during inevitable drawdown periods. I'm just going to stop on this point really quickly because any strategy that I've ever been exposed to or I'm running currently, they will always have drawdowns. And some of them will have different drawdown lengths to others. For example, mean reversion strategies often have a lot shorter drawdown periods, but are often a lot more sharp. And that is a function because they are a higher win rate strategy, meaning when they do lose, normally it's because you have a larger stop loss or things like that, which means you're going to have a fat chunk kind of removed from your equity, but then it will quickly kind of recover, but it is more of a shock to the system, let's say. Whereas trend following, you're going to be losing a lot, very small amounts, but it could be for a very long period of time. And then suddenly you'll get very big winners and you'll start to kind of compound. And then lastly, as with any approach I've talked about on this channel, I'd always say add extra return factors or diversification. That's why I'm adding crypto to my portfolio, because I know I'm primarily overexposed to commodities and indexes. So getting a bit of extra exposure into crypto as well can help increase returns, and I'm happy to take on that risk, but also it's a bit of diversification as well. The $100,000 plus hasn't just come from complex algorithms. It's come from systematic application and time. Now, if you want to see how we apply this systematic momentum approach in real time, including our live positions and our own research, click the first link in the description. Otherwise, I'll have many more free videos in the future as well.